A decade ago, PSU banks were basically considered the sick men of Indian banking. Mountains of bad loans, government bailouts, constant bad news. Today, those same banks just posted their highest ever combined profit 4 years in a row. But here's the twist. Their biggest customers, India's largest companies, have almost stopped borrowing from them. So how are these banks making record profits, and more importantly, where is their next leg of growth going to come from? The answer might surprise you, and it could directly affect how easily your local kirana store or small business owner gets a loan in the next few years. Stick around till the end, because there's also a real risk hiding inside this growth story that most headlines are missing. PSU banks just posted their highest ever combined profit, Rs 1.98 lakh crore in FY26. 4 years in a row of record earnings. Most people saw that headline and moved on. But here's the question that actually matters. These banks have a Rs 127 lakh crore loan book. It has to keep growing. Large corporates, who used to be their biggest customers, have basically stopped borrowing from banks. So where is the next wave of growth going to come from? The answer is small businesses, and the story of how PSU banks got there is worth understanding, because it tells you something important about where the sector is headed. Let's go back a decade first. Between FY15 and FY18, PSU banks were drowning in bad loans, gross NPAs, meaning loans that had gone bad, peaked at 14.58% in FY18. Roughly 1 in every 7 rupees lent was stuck. Here's why that's so damaging. When a loan goes bad, the bank has to set aside money from its own profits to cover the expected loss. This is called provisioning. The more bad loans you carry, the more you provision, the less capital you have to give out new loans. It's a trap. Bad loans don't just hurt today's profits, they kill tomorrow's growth. So PSU banks spent years in cleanup mode. IBC resolutions, that's the Insolvency and Bankruptcy Code, the legal process used to recover money from companies that default on loans. Recapitalization by the government, tighter underwriting, write-offs. And it worked. By end of FY25, gross NPA was down to 1.93%, net NPBA at 0.39%. Provisioning coverage above 90% across the system. Slippage ratio, meaning the ratio at which new loans turn bad, down to just 0.7%. The recovery phase is over. The question now is, what does growth look like? To answer that, you have to understand why SMEs specifically. Start with what happened to large corporates. India's biggest companies don't really need banks anymore for their funding. They go directly to the bond market instead of bank loans. Outstanding corporate bonds went from Rs 40.2 lakh crore in FY22 to Rs 59 lakh crore in FY26. That's a 33% jump in 3 years. As a result, bank loans to large companies fell from 31.3% in FY25 to 22% by Q2 FY26, as these firms shifted to bond markets and industrial borrowing slowed. PSU banks needed new growth to keep their Rs 127 lakh crore loan book expanding, especially as large companies moved to cheaper bond markets. They needed a segment with higher profit margins and untapped potential, backed by government policy. SMEs checked all these boxes. This shift wasn't just a social mandate, it was a necessary business strategy to sustain the bank's growth. Now, PSU banks have tried to lend to small businesses before. It didn't always go well. What changed this time? 3 things. First, digital underwriting. PSBs launched a new credit assessment model in 2025 that pulls GST data, income tax returns, bank statements through the account aggregator framework, and credit bureau reports all digitally. SBI system can deliver a sanction decision in 10 seconds for loans up to Rs 50 lakh with no human in the loop. Between April and December 2025 alone, PSBs sanctioned over 3.96 lakh MSME applications worth Rs 52,300 crore under this model, including a large chunk of first-time borrowers. Second, CGTMSE. This is a government credit guarantee scheme that used to cover loans up to rupees 5 crore. Basically, the government promises to cover part of the loss if the borrower defaults. So the bank takes on less risk. The FY26 budget raised that limit to rupees 10 crore for micro and small enterprises. Budget 2026 added a separate guarantee mechanism for invoice discounting through the TREDS platform, a digital platform where small businesses can get immediate cash against unpaid invoices, which has already cut average borrowing costs for MSMEs by around 8%. Banks combine whatever collateral the borrower has with CGTMSE cover in a hybrid model. That changes the risk math entirely. Third, pricing. With lending rates linked to the repo rate, the rate at which the RBI lends money to banks, which acts as a benchmark for loan interest rates, and repo rates coming down, PSU banks are now offering MSME loans at rates private banks genuinely cannot match. Private banks carry higher deposit costs and tighter credit deposit ratios. That's the proportion of deposits a bank has already lent out as loans. Channel checks across Western India shows PSU banks pricing MSME loans 0.3 to 0.4% below private peers. The numbers bear this out. MSME lending by PSBs grew 18.2% year-on-year in FY26. PSB's share of total incremental credit in the system rose to 57.3% in FY25 from 51.7%. The Finance Ministry set an MSME credit outstanding target of Rs 17.31 lakh crore for FY26, a 19.5% jump over FY25. And in early June 2026, the Finance Ministry called a review meeting of all PSB heads specifically to monitor MSME and agriculture credit flow. This is not a trend anymore. It's a deliberate strategy being monitored at the ministry level. But here's where it gets complicated. 3 things could go wrong, and you should know all 3. 1. Credit quality. Simply put, the RBI flagged that PSU banks have given loans to less trusted MSME borrowers. Because of the new automated system, it's now much easier for the first-time borrowers, people with no credit history at all, to get loans. CGTMSE protects the bank if these loans go bad, but nobody really knows how this entire group of borrowers will behave once a tougher economic cycle hits. 2. Export risk. CRISIL put a number on it. About 12.6% of total bank credit is exposed to US tariffs, and textiles alone account for 43% of that tariff-exposed credit. A large portion of the new MSME book sits in export-linked manufacturing. If global trade stays under pressure, some of this will come back as stress. 3. NIM compression, meaning the gap between what banks earn on loans and what they pay on deposits is shrinking. PSU banks are winning on price. But pricing aggressively on repo-linked rates squeezes the interest income margin. PNB's net interest income, that's the core profit a bank makes from lending before other expenses, fell 1.9% in FY26. Union Bank's NII fell 1.5%, with operating profit down 7.9%. Even as the loan book grew, volume growth without margin is a treadmill, not a business. So what are you actually watching for? CRISIL projects 13% overall bank credit growth in FY27, with MSME and retail as the main engines. That story looks intact, but the real test comes over the next 18 to 24 months as this new MSME book seasons. Are the CGTMSE claims manageable? Do the export-facing borrowers hold up? Does the digital underwriting model perform at scale? PSU banks used to be the banks India needed, basically because no one else would lend to the economy's riskier corners. Now they are trying to become the banks India's small businesses actually want on price, speed and access. Whether that bet pays off, that's the story of next 3 years. If this helps you understand what's really driving PSU bank profits, follow for more breakdowns like this. And tell us in the comments, do you think PSU banks can pull off this SME bet? Or is this growth built on shaky ground? Let us know what you think. Subscribe to Invest with Share.market for more such sectoral breakdowns.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.